We are entering the final countdown as the global silver market approaches a historic rupture that will permanently redefine pricing, supply chains, and the balance of economic power worldwide. Look at the date on your screen and understand that time itself has become a weapon, compressing decades of market tension into a single irreversible moment. In just 36 hours, the sun rises on a world where the Chinese silver export ban transforms from rumor into enforceable law. This is not a future event, because the damage has already begun unfolding across markets, vaults, and balance sheets in real time. For days, we warned of a market bifurcation, but today that split has expanded into a structural fracture with no possible repair. As I speak, there is no longer one global price for silver, only competing realities shaped by fear, scarcity, and physical possession. If you are checking a banking app or mainstream terminal, you are staring at a price that no longer represents the real world. That number is a ghost, disconnected from the factories, refiners, and governments now fighting for tangible metal. A three-tier silver market has emerged, exposing the fatal weakness of paper pricing mechanisms under physical stress. Tier 1 is the panic price in Shanghai, where buyers are paying extreme premiums to secure metal before the gates close. This price reflects desperation from the world's manufacturing engine, entities that cannot function without uninterrupted silver supply. Tier 2 is the physical price in Middle Eastern hubs, where tight inventories command heavy premiums without full panic. These transactions reveal the honest market, one that quietly confirms physical silver is far more valuable than paper contracts imply. Tier 3 is the zombie price in New York, a paper illusion sustained only by algorithms and leverage. The widening spread between these tiers is not inefficiency, it is evidence that arbitrage has failed completely. In a functional market, traders would erase this gap instantly, but the metal can no longer move fast enough. Physical silver is trapped behind regulatory walls, shipping constraints, and geopolitical decisions that paper cannot bypass. The bridge between paper and physical has burned, leaving financial centers isolated from material reality. What you are witnessing is the collapse of price discovery itself under the weight of real-world demand. This is the opening chapter of a systemic repricing event that will echo through every industrial economy on Earth. To understand how extreme this moment is, you must focus on the spread between prices, because spreads reveal stress long before headlines admit failure. Shanghai is paying panic premiums because Chinese buyers understand that supply security matters more than nominal price. These buyers are not speculators. They are manufacturers, state planners, and industrial giants who cannot afford production shutdowns. They are front-running regulation, absorbing losses today to avoid catastrophic losses tomorrow. Meanwhile, the physical markets of the Middle East reveal a quieter truth, one of tight supply without full-blown hysteria. In Dubai and the UAE, silver trades freely but demands a heavy premium as inventory thins by the hour. This is the honest price discovery zone, where metal changes hands based on availability, not leverage. Even here, silver trades far above Western spot prices, exposing the paper market's growing irrelevance. Then there is New York, the last domain of the paper illusion, where prices linger far below reality. This paper price survives only because most contracts never demand delivery. But today something changed, because delivery demand has exploded beyond historical norms. When paper holders suddenly ask for metal, the system's weaknesses become impossible to hide. The widening spread is not inefficiency. It is a warning siren, signaling total arbitrage failure. Arbitrage exists to erase price gaps, but only when goods can move freely across borders. Today, borders, licenses, and time itself prevent silver from moving fast enough. Traders know they cannot buy cheap paper silver and ship it into premium markets. They know the deadline is immovable and the window has already closed. As a result, the spread widens instead of collapsing, defying every textbook model. This is the mathematical proof that silver pricing has broken at the global level. From this point forward, physical possession becomes the only credible price anchor. The true shock arrives when volume exposes what price alone cannot, because volume reveals who is desperate enough to demand delivery. Today, the paper-silver market experienced a historic surge in physical delivery requests, shattering every recent precedent. What once looked like speculative noise has transformed into an outright run on metal. This is not a gradual increase, it is a vertical spike driven by institutional fear. Yesterday, delivery volumes were negligible, reinforcing the illusion that paper markets were stable. Today, that illusion collapsed as thousands of contracts suddenly demanded real bars. In a single session, physical demand multiplied more than 20-fold. This is not normal trading behavior. It is coordinated panic. Banks, funds, and industrial players all hit the delivery button simultaneously. They are no longer willing to roll contracts forward and accept paper promises. They want metal in hand before regulatory doors slam shut. This behavior signals a collective loss of trust in paper settlement. When trust evaporates, liquidity vanishes almost instantly. Every delivery request forces banks to source physical silver they never expected to move. Vault inventories that appeared abundant on spreadsheets suddenly proved dangerously thin. The paper market was designed for cash settlement, not mass physical extraction. Today, that design flaw is being stress tested at full force. Each new delivery notice tightens the noose around bullion banks. The system is now cannibalizing itself to meet obligations. This delivery surge marks the point where paper silver begins converting into real-world scarcity. This sudden extraction of physical silver creates an immediate liquidity crisis inside the bullion banking system. Banks are not failing because prices moved against them. They are failing because metal must now be delivered. Every ounce delivered at today's suppressed paper price locks in a guaranteed cash loss. To survive, banks must raise enormous amounts of short-term liquidity immediately. This is why emergency funding operations suddenly explode without public explanation. Liquidity injections are not a sign of strength. They are evidence of structural bleeding. The banking system is scrambling to convert paper obligations into physical settlement. Each delivery request forces banks to buy silver at panic prices elsewhere. That price difference vaporizes balance sheet capital in real time. This is the hidden cost of years of price suppression through leverage. When the leverage snaps, losses arrive instantly and without mercy. The repo market becomes the emergency oxygen mask for a suffocating system. Overnight cash is burned just to keep settlement pipes open. These liquidity lifelines buy hours, not solutions. The problem is not solvency measured in dollars, but insolvency measured in ounces. Paper currency can be created instantly, but silver cannot. This mismatch exposes the fatal flaw of synthetic commodity markets. The more cash injected, the more visible the physical shortage becomes. Liquidity support delays collapse while accelerating the underlying drain. The banking system is now trading time for metal, and time is running out. While Western banks scramble for liquidity, the physical drain in Asia accelerates into a full-scale depletion event. What began as elevated withdrawals has transformed into a coordinated extraction of strategic reserves. Shanghai's vaults are no longer supplying markets. They are being emptied deliberately. Daily withdrawal rates now dwarf anything seen in modern trading history. This is not routine industrial usage. It is emergency stockpiling driven by state-level urgency. The pace of removal reveals inside knowledge of how restrictive the coming export rules will be. Each armored shipment leaving the exchange permanently reduces global available supply. These ounces will never return to Western markets through arbitrage. The inventory trajectory now points mathematically toward exhaustion. At current rates, remaining stockpiles shrink visibly with each passing day. Markets do not wait for zero inventory to panic. Panic accelerates once psychological thresholds are breached. As inventories approach critical levels, buyers double orders preemptively. This creates an exponential run on remaining metal. The exchange shifts from a pricing venue into a one-way exit. The last buyers through the door will dictate prices for years. This is how strategic commodities disappear quietly before headlines notice. The physical vacuum in Asia amplifies stress everywhere else simultaneously. Every ton withdrawn tightens pressure on Western paper obligations. The global silver market is now governed by depletion mathematics, not sentiment. As inventories vanish, industrial buyers abandon efficiency models and move into full survival mode. Decades of just-in-time supply chains collapse under the reality of physical scarcity. Factories cannot operate on promises, forecasts, or paper contracts. They operate on atoms, molecules, and reliable physical delivery. This is why corporate procurement desks are now overriding price sensitivity entirely. Paying a premium is irrelevant compared to shutting down a production line. Major technology manufacturers are quietly locking in months of silver supply. Overnight, weeks of inventory have become unacceptable risk exposure. Emergency procurement orders pull future demand into the present. This behavior removes enormous quantities of silver from open markets instantly. Each corporate stockpile amplifies scarcity for everyone else. Competition shifts from price negotiation to raw access. Buyers are no longer competing on cost. They are competing on speed. Whoever secures metal first survives the disruption. Late buyers face production halts, regardless of balance sheet strength. This transforms silver from a commodity into a strategic choke point. Industrial demand becomes inelastic under existential threat. Supply cannot respond quickly enough to rising urgency. This imbalance forces prices upward independent of speculation. The industrial panic phase locks the repricing into the real economy. As markets close for the holiday, price screens go dark, but the crisis accelerates behind closed doors. The absence of visible prices does not mean stability. It means negotiations move off-market. While the public celebrates, risk managers enter emergency sessions that stretch through the night. Banks calculate obligations measured in ounces they no longer control. Industrial buyers place bids without regard for published spot prices. Private deals set the real clearing price long before exchanges reopen. This invisible trading window determines the next opening gap. When markets reopen, prices must jump to catch reality. Gaps of this magnitude do not resolve smoothly. They explode into volatility as algorithms scramble to re-anchor. Paper shorts face impossible decisions with no orderly exit. Covering positions requires metal that does not exist. Cash settlement becomes the only offer left on the table. But cash cannot replace missing supply. This is where confidence finally breaks. Force majeure clauses quietly appear in contracts. Delivery timelines stretch beyond credibility. The promise of future metal loses meaning. Legal risk replaces market risk. The paper silver era enters its final hours. When markets reopen, the repricing will not be a debate. It will be a recognition of what already happened in silence. Silver cannot reopen at yesterday's paper price without instantly triggering systemic failure. Algorithms will gap prices upward, chasing a physical reality they can no longer ignore. Volatility will surge because liquidity has already been consumed in the dark. The first trades will not reflect optimism, they will reflect desperation. Dealers will move to limited offers or no offers at all. Premiums will widen faster than spot prices can adjust. The screen price becomes symbolic while real transactions happen elsewhere. This is how price discovery migrates away from exchanges. Force majeure declarations mark the formal collapse of paper credibility. Lawsuits follow, but lawsuits cannot conjure missing metal. The failure is not technical, it is physical. Silver has exited the financial abstraction and entered strategic reality. Nations with stockpiles gain leverage while those without face production shocks. Industrial planning replaces speculative trading as the dominant force. The market transitions from price suppression to price enforcement. Ownership matters more than timing in this new regime. Those holding physical silver hold continuity, not just value. The repricing is not a spike, it is a regime change. The silver market has crossed the point of no return.